Hi, welcome to Trade Zone for the 8th of May, sponsored by Eightcap. So let's talk about markets, Eightcap. Right, let's go. Today we're going to talk about what was the important things, events last week, what was the market impact, and what's important this week. So what happened last week? There was a market moving. We had the U.S. Federal Reserve policy meeting. We also had the European Central Bank policy meeting, Reserve Bank of Australia meeting, as well as their policy statement a few days after the announcements of the decision, and the U.S. jobs data, U.S. Nonfarm Payrolls on Friday. So the week began with some exciting news from the central banks. U.S. hiked 25 basis points to the range for the policy rates to reach the range of 5% to 5.25%. And this is the highest level since the September 2007, so since before the great financial crisis. And they removed an important part of this, the statement. They said that some additional policy firming may be appropriate, which is present in all the statements before these meetings. It has been removed, and now it's changed to something more conditional, as to they will assess if there is additional there is requirement for additional policy firming from meeting to meeting going forward. So, but they did also mention that there will be tighter credit conditions because of the banking crisis, and also mentioned that they will have to assess the cumulative effects of previous rate hikes. So they have hiked a total of 5% from early last year, from March last year. So that's quite an aggressive hiking cycle. As such, I think they are now ready to see if there's additional interest rate hikes required going forward. However, in his press conference, the chairman, Jerome Powell, did stress again that they are prepared to do more if warranted, and they have not yet made a decision on whether they will be pausing in the next meeting. And their priority is still to fight and tame price pressures, and the fight is not yet over. So it would be premature to assume that now they are ready to pause and even start cutting interest rates. And he did say that more data is needed to see if current interest rates are restrictive enough. So he did mention that it is now in the restrictive zone. It is in the zone where it will slow the economy, but it's unsure yet as to how much more needs to be done if it is to slow the interest rates are to slow in the economy to such an extent that inflation will head towards the 2% target decisively. Also, he did push back against the market pricing of interest rate cuts within this year. So he says, as of now, given their projections, given their expectations for how the economy and inflation will evolve, they do not expect to be cutting interest rates anytime soon. So what was the market impact? We saw it in the immediate aftermath of the policy statement and the press conference. There was some volatility, but in the hourly charts, you can see in the stock markets did not really like that he pushed back on the interest rate cuts for this year, and so it fell 1% in response and proceeded to weaken further. But it has since recovered because of various reasons, a bounce back in banking stocks, as well as a stronger than expected US jobs number. So moving on to the European Central Bank policy decision, also a hike of 25 basis points, 0.25% hike as expected by market, but it is a slowdown from pace of previous hikes of 50 basis points, from 0.5% hikes to now quarter of a percent hikes. And the governor did, the president of the ECB did say that they will end the reinvestment of cash from their bond buying program. So that is a bit a tightening measure as well, not so much more asset buyings and allowing the bonds to mature and just drop off from the balance sheet. Lagarde did say that there's more ground to cover and they will not be pausing anytime soon. Although he said that the market impact was a bit to the dovish side, I think it is not as strong as the market had feared. The euro fell almost 0.5% in response to the hike as well as the statement and the press conference. However, again, it has since recovered because I guess dollar has weakened as well in the last few days against the euro, and also the market is not really interpreting the statement as extremely dovish because it did warn of more interest rate hikes going forward as well. The reaction was a bit confusing because on first reading it seems hawkish, but the market did react dovishly to it in the first instance because it is the ECB did not explicitly commit to further interest rate hikes. They said there needs to be more, but they did not commit themselves to a hike in the next meeting. And in the statement as well as in the press conference, they did focus more on the lagged effects of previous rate hikes and the strength of the impact of previous rate hikes on the Eurozone economy. So it's important to read into the details and not just react instantaneously to interest rate hikes, especially given now we are in the later part of the hiking cycles for most central banks. Overall, it was a balanced statement. As such, it did not have a lasting impact on the euro in the FX markets and interest rate markets as well. So the RBA, they hiked 25 basis points early in the week, and the statement came out in the later part of the week. And the statement was that there is a need for further monetary policy tightening, and they are strongly committed still to returning inflation to target, and they fear that energy prices will contribute considerably to inflation in the year ahead. So we did see that it is a more cautious tone again after pausing, but now they are resuming their interest rate hikes because the RBA did not like the way that data is turning out in the last few prints. The market decision, you can see on the first yellow part here, it was the rally of Aussie in reaction to the unexpected 25 basis points hike. Market was thinking that it would continue to pause, but it was a surprise. And after that, it traded in a range for a while, and the statement again provided another boost to the Aussie dollar because they did warn of more interest rate hikes and expectations of higher inflation given the high energy prices that we've been seeing so far this year. So since then, it has continued to trend higher. Short-term support, we see it at around 66.90 to 67 cents, and the short-term resistance is the previous highs from April around 68.10 and 68.20, and in the daily charts, it has broken through the cloud resistance from the bottom, going through. It's likely the theory is that it doesn't last very long within the clouds. It's not much trading should occur within this zone. So if price action continues to follow through, it is likely that we will see higher Aussie in the days and weeks ahead, especially if it breaks through the 68.10 level strongly. As such, I think for now, it should be a buy on dips based on technicals as well as fundamentals, given the more hawkish than expected statements from the Reserve Bank of Australia. So the non-farm payrolls, the most important data point of the week, outside of the central bank meetings, it showed that the US jobs market remains extremely resilient despite a hike of cumulative total hikes of 5% since early last year. The jobs market continued to grow strongly. 253,000 jobs were added. Expectations was only for 180,000 jobs. The previous print in March, the first estimate was that 236,000 jobs were added, but it seemed that only 165,000 jobs were added. So this is kind of a bit of a wash, but still it shows that on the average, the number of jobs being added per month is still very healthy. It's still being added at a healthy clip. And more importantly, the unemployment rate, which was expected to rise from 3.5% to 3.6%, surprisingly dropped to 3.4%. This will, of course, this will give the US Federal Reserve cause to remain extremely vigilant about inflation and about the how much they need to continue doing to keep inflation headed towards a 2% target. Participation rate was the same as before, nothing new there, but strong data shows jobs market still resilient. So the Fed is likely to remain, stick to its tone that they will keep interest rates higher for longer and just until inflation is decisively headed towards the 2% target. Recession fears was reduced because of these strong jobs numbers, and and surprisingly, the stock market reacted positively. It rose almost 2% after the numbers. Typically, what would happen when we have a drop in the last few months, especially when we see stronger than expected job numbers, we will see a jump in US US bond yields, and then as a result, we will see the stock markets weaken because the investors, speculators, and all will be fearing that the Fed will continue to be aggressive, continue to hike interest rates, and that should weigh on risk assets and the stock market. But instead, we saw the stock markets rally because I think the more important reaction was that fears of recession went lower, and also the banking sector, the regional bank stocks rose strongly on Friday after some short covering. So it's important. I guess the lesson here is to know that important at different juncture, at different parts of the cycle, depending on the news flows, the market reacts to data differently. So what's going to be important this week? We are going to see US inflation data, the CPI on Wednesday, and that should be very important given that the Fed's primary focus still remains to be inflation. So if we should see a higher than expected print, we are going to see a weakening of risk sentiment, and vice versa. We also will be seeing the Bank of England deciding on policy this week, and more importantly for now, especially given that the US regional bank situation is not yet resolved, markets still fear that more banks will fail. We will have to keep monitoring this. What are the expectations for this week on this data point? US inflation data is expected to show that prices rose year on year 5%, which is what it was in March. This is expected to be the same results for April as well. As I said earlier, a stronger than expected number will weaken risk sentiment, and downside surprise will be good for markets and will be greeted with likely a strong rally in risk assets. The Bank of England is expected to raise interest rates by 0.25% to 4.5%. Inflation remains a big problem for the Bank of England, for the UK economy. It's still very close to 10%, and it's unlikely to head towards their target anytime soon if they do not have a better plan than what they've been doing so far. And as I mentioned earlier, the US banking stocks, especially the regional bank stocks, will be closely monitored by investors as it's an indication of how the banking crisis will continue to Well, the policymakers say it's not a crisis, but to me, it is the start of a crisis. On the sector-wide problems remain. They still have bond and loan portfolios that remain underwater, and confidence within the sector remains very weak. And we are likely to see more deposits withdrawals in the weeks and months ahead because the interest rates that they're paying on the deposits are still too low compared to market interest rates. That's it for the week ahead. And I wish you a very good week ahead, and thank you for joining us in Trade Zone. As always, stay true to the process, and eventually you'll build habits that will lead you to success in the future. Thank you. Take care. Bye-bye.